Somewhere right now, an algorithm is deciding whether someone gets a home. Not a human, not a banker looking you in the eye. A machine learning model trained on data you've never seen, using logic nobody can fully explain, is making the most important financial decision of your life. And here's the part that should terrify you. A 2021 investigation by the Markup analyzed over 2 million mortgage applications and found that Black applicants were 80% more likely to be denied than white applicants with similar financial profiles. Latino applicants were 40% more likely. Native American applicants, 70%. Not in the 1950s. Right now, 45 million Americans don't even have a credit score. In the UK, 450,000 bank accounts were closed by algorithms in a single year, 10 times more than a decade ago. The financial system is increasingly run by artificial intelligence, and that AI is deciding who gets to participate in the economy and who gets locked out. This is the story of how algorithms became the gatekeepers of money, why they're biased, and why the future could be even worse. In the 1930s, the US government literally drew red lines on maps around Black neighborhoods and told banks not to lend there. It was called redlining, and it was one of the most destructive policies in American history. It was outlawed in 1968, but the discrimination didn't disappear. It moved into the code. Today, virtually every major mortgage in America runs through automated underwriting systems. Fannie Mae's desktop underwriter and Freddie Mac's loan prospector process the vast majority of applications. These systems analyze hundreds of variables to decide in seconds whether you qualify for a loan. A 2024 study from Lehigh University found that Black and Hispanic applicants need a credit score 120 points higher than white applicants to receive the same approval rating. White applicants are 8.5% more likely to be approved even when income, debt, and credit history are identical. And it gets worse. A UC Berkeley and Stanford study found that minority borrowers pay 5.6 to 8.6 basis points more in interest, even through digital lenders. That adds up to $450 million per year in excess interest charges paid by minority borrowers. The algorithms don't use race as an input. They don't need to. They use zip codes, which correlate with race. They use education history, employment patterns, spending behavior, all of which carry the fingerprints of decades of systemic inequality. The AI doesn't discriminate on purpose. It just learns from a world that already does. The traditional credit system was already broken before AI got involved. 45 million Americans are either credit invisible, meaning they have no credit file at all, or unscorable, meaning there isn't enough data to generate a score. 27% of Black consumers and 26% of Hispanic consumers fall into this category, compared to only 16% of white consumers. So a new wave of fintech companies promised to fix this. Companies like Upstart and Zest AI said they could use artificial intelligence to score people that traditional systems can't. Instead of just looking at your FICO score, they analyze alternative data. Your education, your job history, your bank transactions. Upstart claims their AI approves 35% more Black applicants and 46% more Hispanic applicants than traditional models. They've issued over $40 billion in loans. But independent monitors have found persistent approval disparities for Black applicants even in Upstart's system. And then there are the companies that go further. Firms like Creditech and Lendo EFL have analyzed social media activity, phone usage patterns, and online shopping behavior to determine creditworthiness. Your Facebook friends, how often you charge your phone, what time you browse the internet, all potentially feeding into a score that determines whether you get a loan. The problem is obvious. When you expand the data, you expand the opportunities for proxy discrimination. An AI might learn that people who shop at certain stores or live in certain areas are higher risk, and those patterns map directly onto race and income. Getting denied a loan is bad enough. But imagine waking up one morning and finding that your entire bank account has been frozen. No warning, no explanation, just a message telling you that your account has been closed. This is the debanking crisis, and it's happening at an alarming scale. In the United Kingdom, 450,000 bank accounts were closed in 2024 and 2025, up from just 45,000 a decade earlier, a tenfold increase. 140,000 small business accounts were shut down by the 8 largest banks in a single year. The most famous case was Nigel Farage, whose private bank Coutts closed his account. An internal dossier revealed the closure was linked to his political views. The CEO of Coutts and the CEO of parent company NatWest both resigned over the scandal. NatWest settled and apologized in 2025. But most debanking victims aren't famous. They're ordinary people caught in AI fraud detection systems. Chime, one of America's largest digital banks, received nearly 8,000 complaints with the Better Business Bureau in just 3 years. Their software flagged legitimate transactions and closed hundreds of accounts simultaneously. Revolut was fined €3.5 million by Lithuanian regulators in 2025 for compliance failures. Here is the fundamental problem. These AI systems are optimized to minimize fraud risk for the bank. A false positive, locking a legitimate customer, costs the bank almost nothing. A false negative, missing actual fraud, costs them millions. So the algorithms are built to err on the side of blocking you. And when they do, good luck getting a human on the phone to fix it. When a bank denies your mortgage or closes your account, you have the right to know why, at least in theory. Under US law, the Consumer Financial Protection Bureau requires lenders to provide specific adverse action reasons when they deny credit. But here's the catch. Modern AI models, particularly deep neural networks with millions of parameters, cannot produce simple explanations. They can tell you the output denied, but they often cannot trace the reasoning in a way that a human can understand or challenge. This is the black box problem, and it is one of the defining tensions of AI in finance. Europe tried to address this with GDPR, which includes the right to meaningful information about the logic of automated decisions. But enforcement has been inconsistent, and the UK weakened its protections in 2025 with an ambiguous standard around what counts as meaningful human involvement. In the US, there is no comprehensive federal law governing AI decision-making in finance. The CFPB has issued guidance, but in April 2025, an executive order eliminated disparate impact liability, meaning regulators can now only act on intentional discrimination, not discriminatory outcomes. If an algorithm produces biased results but nobody designed it to be biased, it may no longer be legally actionable. We are building systems that make life-altering decisions but are legally and technically immune to meaningful accountability. And the algorithmic gatekeeping doesn't stop at banks. The spreading everywhere. Insurance. In 2022, health insurer Cigna used an algorithm called PXDX to deny over 300,000 claims in just 2 months. Doctors reviewing the denials averaged 1.2 seconds per case. One doctor rejected 121,000 claims in 2 months. United Health's NH Predict algorithm allegedly had a 90% error rate when predicting how long patients should stay in care facilities. A class action lawsuit is now proceeding. Housing. A tenant screening company called SafeRent paid $2.3 million to settle allegations that its algorithm discriminated against housing voucher users, who are disproportionately Black and Hispanic. Landlords increasingly use AI to decide who can rent, and tenants rarely know an algorithm scored them. Employment. In 2018, Amazon scrapped an AI hiring tool after discovering it systematically downgraded women's resumes. A 2024 study found that AI resume screening preferred names associated with white applicants 85% of the time. The pattern is always the same. An AI trained on historical data learns historical biases. It deploys those biases at massive scale with zero human oversight, and the people affected are the last to know. The AI in finance market is projected to grow from $38 billion today to over $190 billion by 2030. 85% of banks globally now use AI for lending decisions. The AI lending market alone is projected to reach $2 trillion by 2037. Every year, more decisions move from humans to machines. The European Union is trying to get ahead of this. The EU AI Act classifies credit scoring and financial risk assessment as high-risk AI, requiring transparency, human oversight, and bias audits. Full compliance is required by August 2026. Colorado has passed the first comprehensive U.S. state AI law covering financial services, effective June 2026. Over 1,000 AI bills have been introduced across U.S. states, but regulation is moving slowly, and the industry is moving fast. Open banking is giving AI access to even more personal financial data. Digital identity systems are creating permanent financial profiles. And the next generation of AI models will be even more powerful and even harder to explain. The question we face is fundamental. Do we want a financial system where access to a home, to credit, to insurance, even to a bank account, is determined by algorithms that nobody fully understands and nobody can effectively challenge? Because that's the system we're building. And right now, the people most affected by it are the people with the least power to change it. The 45 million Americans with no credit score. The minority borrowers paying $450 million extra every year. The hundreds of thousands of people debanked by machines. We can build AI that expands access instead of restricting it, but only if we demand transparency, enforce accountability, and stop pretending that an algorithm is objective just because it's automated. Thanks for watching. Subscribe if you want to stay informed on the forces shaping our future.